All right, everyone. Welcome to Tax Tuesday. I'm your host, Amanda Winalda, joined here by...
Elliot Thomas.
Yeah,
Good to be here.
it is. It's good to be here. We walked up all the way from downstairs
Yes,
together.
took a long journey to get here, but we're here.
We are thankful you guys are here. Why don't you throw up in the chat where you're joining us from?
Yeah. Exotic locations.
Yeah, any exotic locations? Let's open this chat up. No one's here.
No one's
No
yet.
one's here
No.
yet. There must be a delay. All right,
Maryland.
Maryland.
The Terps, go Terps. I'm an Orioles fan, go Baltimore.
Florida's here.
Very cool state.
Welcome,
Very
welcome.
nice.
Idaho, Boise
Very cool.
specifically. Always some people from California. I'm
Welcome.
California native, so welcome. We're out here in Las Vegas.
Yes, fabulous.
It's getting pretty cold out here. Oh, not as cold as Chicago, though.
No. Burr.
Bakersfield, Washington, San Diego. We always get people from all over the U.S.
Yes.
Usually at least one or two from
International.
international, yeah.
Ann Arbor.
Well, we've got a whole group of tax professionals helping out in the Q&A, so let's go over quick rules. We have the live Q&A, so if you have a question, we have 10 questions Elliot picked for us, which we'll be going over. But if you have a question, whether related to what we're talking about or not, we have got an awesome group of tax pros here. We've got Tanya, Jeff, Dutch, Jared, Arash. They're gonna answer all those questions into the Q&A. Also, if you're joining us live on YouTube, we've got Troy manning the chat there. So hit us with what you've got. It's the end of the year,
Yes,
so
last episode.
last episode
So
of
welcome.
the year. We expect some crazy stuff from you guys, so keep us guessing. All right. If you do not get your question answered, you can email taxtuesday@andersonadvisors.com. Elliot goes through all those emails on a biweekly basis, picks out the top 10 or the interesting ones. We try to keep a good mix going on. Or if you need a more detailed response than what you're able to get into the Q&A, and you're a platinum or tax client here at Anderson Advisors, you can reach out to your team, submit a question. We can jump on the phone, get that answered for you. But this is basically a fast, fun, and educational way to get tax questions answered.
Yes.
Yeah.
A lot of fun.
There are worse ways to spend your afternoon, right? Okay. We're just going to go over the questions real quick. First one will be, what are the tax implications of moving into one of our rentals? So we're talking about a rental into a personal property. They bought the property 13 years ago, have never lived in it, taken expenses and depreciation on the returns. Or should we just rent it from ourselves through our property manager? They own 3 other rentals as a sole... That's the second one. That's the second question. Sorry, I'm going a little
No,
too
you're
fast.
good.
So that's
You're good.
question 1. Question 2 we're going to look at is 3 residential rentals as a sole prop, and what the taxes would be if they move to an LLC. Elliot, why don't you go through the next couple for us?
Yep, I have 3 single-family rentals that I manage myself. I also have an LLC. Can I use that LLC as a management company, take a 10 to 15% management fee, and use that money as an earned income to allow contribution to my personal IRA? Excellent question. Would that contribution be deducted from my rental income as cost to the rentals in Schedule E? When is the deadline for the contribution? My LLC has some expenses too. If my net income is only $3,000, can I still contribute $7,000 to my personal IRA and deduct that amount?
Ooh, a lot going on there.
There is, but that has a lot of good elements to it. So, second, can I use negative cash flow as a deduction towards income / capital gains? I'm in California and nothing cash flows for at least a few years. If I'm negative $1,000 or more cash flow, is this a deduction against passive income or capital gains?
Ooh, good one, good one. A reminder, if you guys are joining us live and you're throwing a question at us, please put it into the Q&A. That's where we'll be able to answer it for you. The chat is more for technical difficulties, things like that. So go to the Q&A if you're asking us any questions. All right. What expenses incurred for rental properties are tax deductible? And what is the best way to stay organized when keeping records of bills and expenses for rental properties to make it easier at tax time?
Good questions. Can I transfer the ownership of a property owned by an LLC taxed as a partnership that I purchased as a replacement property in a 1031 exchange? Or will that trigger a taxable event?
1031 is always raising red flags. You got to do those perfectly for them to work. All right. My wife receives income from multiple sources, real estate rental, consulting, etc. We plan to set up a C Corp to consolidate the passive income and offset some of that income with retirement contributions into a solo 401k. Unfortunately, we did not set up the C Corp in time for the tax year 2024. What options do we have with respect to retirement accounts to offset her passive income for 2024?
What can we still do? Can multiple individual LLCs, mix of small business and rentals, be consolidated into one tax return under a Wyoming holding company? If so, is that a recommended practice?
Wyoming Holding Company, that sounds like somebody who visits our YouTube channels
Yes.
a lot. How much can we deduct with a 529 plan for our kids?
Good
I
question.
know 529s today.
If I gift my stock to my aging dad and become the beneficiary of the stock when he passes, will I get the stepped up basis after I inherit them?
We shall see.
Yeah, all these
We shall
exciting things.
see. All right, we're on Toby Mathis's web or YouTube channel. Toby is one of our founding partners here at Anderson Advisors. Subscribe. You'll get a notification every time he uploads a new video. I honestly don't know how he does so much
Right?
content. He is just an
900 plus.
encyclopedia when it comes to tax issues, questions,
And videos.
We had our live tax and asset protection
Yeah.
event last 2 weekends
Yeah,
ago.
yep.
And he spoke for probably a few hours, a couple hours at least, and he felt like he didn't get even enough. So he sent out additional content, an hour and a half extra
you
video
go.
of additional content. This man is a machine.
Does not shut down.
Yeah, our other founding partner is Clint Coons. He focuses more on real estate asset protection. Between them, they have over 300 plus rentals. And so all of these strategies, whether on the tax side or the asset protection side, come from real world experience. So
They definitely walk the talk.
talk the walk.
Talk the walk, whichever
We're
it
out
is.
in there in the trenches with you. So remember to like and subscribe there. Speaking of our tax and asset protection workshops, we have a couple coming up. There's our free virtual events. Those are about from 9 to 4 o'clock on Saturday. We've got one coming up on December 21st. I will be there teaching advanced in tax strategies and estate planning. And then we've got another one on December 28th. These are really great. We actually do some really great offers and deals. These are kind of
There
the
you go.
best prices out there for us. All right,
Gotta
first
check it out.
question. You do, you should come. You should come, learn something, Elliot. What are the tax implications of moving into one of our rentals? We bought the property as an investment 13 years ago, have never lived in it, and have taken expenses and depreciation on our returns. Or should we just rent it from ourselves, maybe through a property manager? So let's take this piece by piece. What is the tax implication of moving into the rental?
Just moving into it, really no tax consequence. You're just going in there and, I guess the difference is that it's no, assuming that you're not renting it, that you're just going to go ahead and call it your home. Right there, really nothing has changed other than you're not claiming rental income anymore and you're not taking the associated deductions for it. That's certainly different. The interest and property taxes and things like that will go on your Schedule A now as an individual. But aside from that, what
You
we,
gotta itemize though.
yes, you're gonna have, that's
So if
exactly
you're
right.
taking the standard deduction, you'll actually lose some
Correct.
deductions
Yes.
on your tax return. But if you're itemizing salt, state and local taxes, mortgage interest, you can
donations,
deduct that
yes,
still on
things of
your
that nature.
Schedule A.
Yeah, to get above your standard deduction. Now, when you move in there, your basis in the house is going to change. When you originally purchased this house, you bought it for X amount of dollars, and there's been some depreciation over the years as you rented it out. That's what we call the adjusted basis, and that's going to be your basis right now. So if you sold it, if you stayed there for a while as a personal residence and then sold it, you're going to have that lower adjusted basis typically, and that's going to figure into whether or not you can do the 121 exclusion on the sale of your primary residency, things like that. The fact that you had what we call non-conforming use, you use it as a rental first, that's also going to come into play if there was a 121. 121 is just if you sell your primary residence after you've owned it and lived in it as a primary residency for 2 of the last 5 years, then you can get a deduction 250 single, 500,000 married filing joint. But that's going to be factored by that time you spend it as a rental. It's going to lower how much we can actually defer or
Yeah.
exclude.
So once you move in, you're not paying capital gains once you're turning into your primary residence.
Correct. There's no tax event in that regards. Correct. Yep.
So go a little bit tell me more about how the new basis is figured out. So give me an example.
So originally we bought, let's say for 200,000, that was our original purchase price. Let's say 25,000 of that was our land. So we couldn't depreciate that. So that just gets set aside, the 25,000 for the land. But that means you have 175 that was available for basis to be depreciated at that point. Now just for, example, let's say we took 50,000 of depreciation from the 175, that will leave 125 as what we call the adjusted basis. So now when we move into it as our primary residency, again, assuming that we're not renting, and we'll get to that part, but if we use this as our primary residency, then that's our new basis, 125. And why do we care? Because again, if we're there for over a couple years, owning it and using it as our primary residency, then we might be able to take advantage of section 121, which is the exclusion on the sale of your primary residency. 2 or 5 years. So that's going to be impacted because 125 will be your new marker, not the fair market value when you moved into it. A lot of people think you get that adjusted stepped up basis, perhaps you do not, because here we didn't sell it, you just moved into it. There's also more complications or calculations, I should say, that will go into how much of that 121 exclusion will be allowed, because you had a lot of years, 13 years, of what we call non-conforming use, where you didn't use it as your primary residency. So there's going to be a fractional impact by that 13 years. So you may not have much to use of the 121, but there'll be something, and that certainly helps.
Will that fraction increase if you stay in it longer than 2 years?
Yep, the longer you use it as a personal residence, the more you'll have available of the exclusion later on. But it's still at 13 years, it's probably going to be a hefty amount that you can't use. Yeah.
All right, so the other option they have is to rent it from themselves. We generally think that renting your own property from yourself isn't going to work for a number of reasons. First, the rent that you're paying with post-tax dollars, so it's income that you've earned some other way, paid taxes on, and now you're paying yourself in rent, only to circle it back through your own tax return to pay tax on it again.
Exactly.
That's no fun.
Yeah, no, it's really not a good theory or practice.
But we also run into some vacation rental rules. Can you explain those?
Yes, we have another rule in the code that says if you stay the greater of 14 days or 10% of the fair market rental days, then you could be limited in how much you can take as a deduction. So we're going to step back from this for a second. Let's just say you have a beach house or something like that you like to use, who wouldn't? But if you stay there too much, and it is a rental normally, if you stay too much, you're not going to be able to take all the deductions that you want to, as you would be accustomed to as having a rental property. You're going to be limited to the amount of income, and your amount of income here is what you pay as rent. So you'll only be able to deduct up to that amount. The other losses just kind of get trapped, and we may not be able to take them. So that's kind of we frown on that a little bit.
Yeah, so on renting it from yourself, the income and expense, the best you could do is zero it out. But from a tax perspective, because you're using post-tax dollars, you're paying tax on that twice. It's not going to work out so great. So the bottom line is no more deductions, no more rental deductions unless you're itemizing. And if you end up being able to take advantage of the 121 exclusion, it's going to be a proportional interest based on how many years you've lived there.
Exactly.
All right. I own 3 residential rental properties as a sole proprietor. Would the taxes on each rental be higher or lower or stay the same under an LLC? So this is a situation where just an individual owns 3 rental properties in their name.
Yep.
Are the taxes going to be different in an LLC?
Typically speaking, they're not. They're not going to be any different, because if we put it into a disregarded LLC, which just means it doesn't file a return, it comes onto our 1040, just like you're doing right now, it's still going to go on Schedule E, then there isn't any difference in the taxes. There may be an annual filing fee, costs of setting up the LLC, things like that, but those are kind of minor in the bigger scheme of things here. So you're still going to have so much income coming in, so many deductions, and that won't change.
A lot of times when you're setting up a structure, even your bookkeeping's not. The way you're keeping records doesn't change a whole lot. Especially with the disregarded entity, what normally showed up on your Schedule E page 1 will still show up on your Schedule E page 1. You will be able to take the expenses for setting up the LLC, maintaining the LLC. That's going to be an additional deduction. So really, when you step back and look at it, On the tax side, you break even, but on the asset protection side,
Huge difference.
huge difference, huge benefit to not only have the inside protection where your entity, your property is not going to attach to your liability to you personally, but vice versa. If you go out and get a judgment against you, your creditor's not going to be able to reach past that LLC and get to your property. So on the asset protection side.
I would just add one more thing here. When we always talk about LLCs, it does matter how that LLC is taxed. For rentals, we're always going to tell them to put in a disregard like we talked about, or a partnership, because that all comes back to our return. But that LLC could be an S Corp or a C Corp. Now, we never recommend really putting an appreciated property into there. So yeah, that's a no, other than Clint's video where he talks about selling your personal residence if you want to hold on to it and turn it a rental, but that's something completely different. So just make sure we're not turning this into a C Corp or an S Corp.
Yeah, the answer to this question changes dramatically if the LLC that you put your properties in, you tax it as a C corporation.
Yeah, because they got a flat rate of 21%. But don't go thinking that that makes it a good idea if you're in a higher tax bracket.
Yeah, stick with disregarded entities. All right, I have 3 single-family rentals that I manage myself. I also have an LLC. Can I use that LLC as a management company, take a 10 to 15% management fee, and use that money as an earned income to allow a contribution to my personal IRA? Would that contribution be deducted from my rental income as a cost to rentals in Schedule E? And when is the deadline for the contribution? My LLC has some other expenses, so the net income in the LLC is only $3,000. So what we're really looking at here, the 10,000-foot view, is taking passive income, passive rental income, running it through a management company to make it active so that the person asking the question can qualify for retirement contributions. Can we do that?
Quick answer, yes. Yeah, we can move it over when traditionally your rental income is passive, as you were just discussing.
That's what I just said.
Right. And because of that, because we move it into the management fee, that's an active business. So we have changed it into active income, which then, if that LLC again is disregarded, sole proprietorship type thing, that comes directly to your personal return earned income, and we could do exactly what you say.
Schedule C. Logistically, we need a management agreement, so you want to set up a management agreement for that fee on that side.
And we want to actually pay it.
We want to actually pay it.
Yeah, before year end. That's a very good, before December 31st.
And then if it's a Schedule C, if your management company is disregarded Schedule C, how does that payment to an IRA work?
Then you have earned income, let's say it's $10,000, you would be able to contribute up to 20% on a sole proprietorship into an IRA. Or excuse me, well, all that is earned income. So an IRA, I'm thinking of a SEP, IRA here, you would be able to contribute up to $10,000 because you have that much earned income. So that's fine. I think it's $1,000 extra if you're over 50, the catch up. So we'd have 7,000 or 8,000 in my example. However, going down here, we see that the net income is only 3,000. So there we would be limited to 3,000 that we can put in, unless we had other sources of earned income.
So the IRA, the max contribution 7,000, and it's not limited by the total income through the Schedule C.
It is not. It's just all overall earned income.
What if we did a SEP?
A SEP, then that typically is sponsored by the business, the sole proprietorship, the management company in this case. And there you can contribute quite a bit, but it's going to be, in the case of a sole proprietorship, 20% of your net income, as I was saying earlier. If this was like, say, if the LLC was a C Corp or an S Corporation, we'd have to pay you a wage, a W-2 wage, and then it would be 25% of that amount that the corporation could put into a SEP. A SEP is a business plan deduction, so it doesn't have anything to do with the individual. It's really the business contributing to it. So we don't have things like the ability to pay catch-ups and things like that.
An alternative, if you do a C or an S Corp for the management company, would be to do a solo 401k as well.
Absolutely. Really good plan.
Yeah, the same thing. You would have to pay yourself a wage. The company could match that up to 25%. And the total amount you can get into those things is $69,000 a year.
Yeah, no, a solo, then you do have the catch-up. Again, if you're over, you get to add $7,500 there.
So for this particular question, the 10 to 15% management fee with about $3,000 coming through, would you recommend them sticking with a disregarded management company or running it as a C Corp?
If we feel really obligated that we really want to put into an IRA, then I'd probably stay with an LLC tax, sole proprietorship. But personally, if you had this as a C corporation, well, then you can move it over there and get that 3,000 back without paying any tax on it. So
That's true.
you got to weigh it out. 3,000 is a difficult amount. That may not be enough to warrant the extra return of a C corporation, management C corp. But if that number changes, and we're just using this as an example, only 3,000, maybe it's a little bit higher, then maybe C corporation would be a preferred use of the
Yeah,
LLC.
because then at that point, you're pulling the money out as a tax-free reimbursement for things like your cell phone, your internet, your mileage, your out-of-pocket medical, 280A meetings. But if your goal is for that retirement planning, then this is a great plan.
It is. Yep. Very good question. A lot packed in there, but
There was.
it's a good question.
Can I use negative cash flow as a deduction toward income capital gains? I'm in California and nothing cash flows for at least a few years. If I'm negative 1,000 or more cash flow, is this a deduction against passive income or capital gains? So let's start off by assuming we're talking about rental properties here.
Right.
When you guys submit your questions, more info is always better. So we'll assume you've got rental properties, negative $1,000 at the end of the day. Is this a deduction against passive income or capital gains?
So first, I just want to talk about negative cash flow. That's really not a tax term. That is more just your bank account, whether you had more rents coming in than you did expenses. In this case, we didn't, it sounds like. So we really wouldn't use this in a tax aspect. However, with that being said,
What's the translation?
yeah, when we're talking on this case, we're just talking whether we have net income or net loss. That's our tax way of describing it. And if we were indeed negative cash flow, I'd be hard pressed to see how you could have that situation and not have a loss, an overall net loss on this. So we're going with the assumption that we have a net loss after depreciation and things like that and all expenses. Now, because it's a rental, we're going with that assumption, then it is passive probably, and that passive loss can only be offset against passive income. So you got to find another source of passive income to offset that against. It will not offset against capital gains. Those are a different type of
Two
income.
different things.
Yes.
Two different things.
Right.
The capital gains come into play if you sell the property. So if you're doing 1,000 in losses every year and you go and sell the property, so you've built up passive activity losses or PALs, what happens if they goes and sell the property at that point?
Right. If we sell that property later on and we've built up these passive losses, we can release the PALs, as we call it. And that means that those passive losses from that one property will first come in and wipe out what would otherwise be capital gains on that. And so we'll knock it down. Let's say we sold for $1,000 and we had $800 worth of passive losses. I had 1,000 gain, excuse me. That passive loss, the 800 would come in and wipe out the first of the 1,000. So you'd have 200 at that point left over. Then at that point, you could pull passive losses from other buildings or other rentals that you have to offset that last 200. Or if you sold, let's say, and you had a $1,000 gain and you'd built up 1,200 of passive losses on that one building, all 1,200 will wipe out that 1,000 and the extra 200 will go against any other income on your return. They're just like an ordinary loss. So it could be very beneficial
Yeah,
from a
it could
tax
be
planning.
beneficial in the
Yep. But it doesn't go against our capital losses. Let's say if we were selling stock, and an extra $200 in my example would, if you didn't have any other ordinary income. But generally speaking, a passive loss without selling just within an ordinary year will not offset against capital gains.
Yeah, so if you have passive loss on this year's tax return and some capital gains, those two things aren't gonna
Right.
offset each other.
Exactly.
Alrighty. What expenses incurred for rental properties are tax deductible, and what is the best way to stay organized when keeping records of bills and expenses for rental properties to make it easier at tax time?
Yeah, this is clearly going to be what I'm going to say. Go, get on and Google IRS PDF Schedule E.
Schedule E, page 1. Got an
Yep.
example right here.
We
Hold
do.
it up. Hold it
Yeah,
up,
I gotta
Elliot.
find it here.
All your chicken scratch. It's gonna list the exact expenses that you can
Oh, we
take.
can see that.
Can't really see it.
No.
It lists the exact expenses you can take. Read them off.
Yeah, we got advertising, mileage, cleaning, maintenance, commission, insurance, legal and other professional, Anderson, management fees, mortgage interest, repairs, supplies, taxes, utilities, depreciation, and another category for anything else.
That's gonna include probably HOA fees, gardening, landscaping, pool service, things like that. So
And
a
if,
lot.
yeah, and then to organize all this, it's going to be your bookkeeping. Bookkeeping is fundamental. You have to have good bookkeeping. And how you're going to do that, you're going to have these categories here for expenses. That's exactly what you're going to do because that's what the IRS wants to see. So you categorize according to these, get that PDF, Schedule E from IRS, and it will show you exactly what to put into your bookkeeping. We got bookkeeping here.
Yeah, we do. We've got actually a special, our bookkeeping essentials package, 3 months, plus it includes the QuickBooks Online, and it does not matter how long it takes for us to do those 3 months of books. It's all included and at no additional cost. And then after that, if you want us to continue doing your books, they'll give you a quote based on how long it's taken those 3 months. But it's $9.95 for new Anderson created entities and $11.95 for a non-Anderson or a client-formed entity over a year old. I'm probably gonna throw a curveball at Miss Patty, but probably find a link to throw up into the chat for you. I'm gonna throw a curveball at you and say, tax deductible expenses, is there a line, or talk to us about what sort of capital improvements I can deduct just in that calendar year?
Yeah, that's a great question because there's a lot of different ways to look at those capital improvements. They could be added to basis and we have to depreciate them over time. Not as much fun as immediate deductions.
Not as much fun.
No, but we have things, you've heard Toby talk about this many times. You can have the de minimis election, $2,500 de minimis election. Everything you buy on an individual purchase that's under $2,500, you can typically go ahead and expense, even if it would traditionally be something that you'd have to depreciate. So that could be something to take advantage of. We also have a category that if it's something, let's say it's 5-year property, typically depreciable property that you put in there, and maybe it has to be repaired usually every 3 years. That's something that because you have to repair it within the lifespan of it, the depreciable life, you can go ahead and expense that as well. The maintenance expense under that, that's an exception to capitalization as well.
Give me an example.
Yeah.
What's 5-year property? Give me an example.
Yeah, let's say you have, well, it's winter time. Let's say you're in the colder regions and you have a fireplace, and maybe something gets broken there, and every 5 years you're having to replace it. But it's 10-year property. It'd normally be depreciated over 10 years, but you're having to repeatedly replace it or repair it, put major repairs in. Then that you could go ahead and automatically deduct the cost of.
That's fun.
Yeah. And if you put all these together, if we have enough going on as far as those capital bases and things like that, we can always look at doing a cost segregation and maybe bonus depreciation. That's always something to look at as well. But that would probably be a little bit higher, dollar amounts we'd be looking at there before we do that.
I will say, in terms of keeping and staying organized, bookkeeping is essential because if you're hiring outside parties or contractors to do any of this work, you are going to have to send them 1099s. Those are due January 31st, and it's going to be a whole lot easier to send that 1099 if you've got bookkeeping, especially if you're hiring the same company repetitively to do things and you're having to consolidate everything you've paid them throughout the year into one 1099.
That is a huge point. Get that 1099 for your independent contractors. Every year we run into that issue. Hey, I paid somebody. They told me they're going to give me their information. Guess what? You didn't get it. Now you're kind of on the hook from the IRS if you don't
Yeah,
watch
you definitely want to get that tax, which is W-9, W-4.
Yes, W-9.
W-9. You definitely want to get that W-9 before W-4.
Yeah, it's one of those. I think it's the W-9.
Before you pay them that final payment.
W-4 is a W-2, I think so.
That's right.
Yeah,
All right.
W-9.
Can I transfer the ownership of a property owned by an LLC taxed as a partnership that I purchase as the replacement property in a 1031 exchange, or will that trigger a taxable event? So can you transfer it?
Can we?
Sure.
Yeah, absolutely, no problems.
But will that trigger a taxable event?
Very well might.
Yes, it will. So 1031 exchange, I expect if you're spending your afternoon listening to two attorneys talk about tax that you're probably familiar with the 1031 exchange. But for those of you who aren't, it's a specific way that you defer gains on a rental property by taking those funds and rolling it into a new rental property. There's a very specific timeline you have to follow, but the new property is what this person is calling the replacement property. Because it is a tax strategy, typically the original property and the replacement property are going to need to hit the same tax return for the consecutive years. And that's what allows you to defer those taxes. But with a partnership, we're looking at a partnership return.
Right. Partnerships are treated a little bit better, so that's exactly right. You'll have, in this case, the 1031. You're giving up a property that you'd used in a trade or business. That's key. You give it up, you're picking up a new one. That's the replacement property that the individual is asking about here. And that replacement property of, if you'd had gain, if you'd sold the first property, you can defer that gain if all the numbers work out for the replacement property and you defer it. So, but to defer it, one of the things is you have to keep same taxpayer rules. So that means in this case, a partnership, it was in partnership A, the one you gave up. Well, that means you have to pick up the replacement property in the same partnership A. You can't put it in a separate partnership, a different partnership. That's something that will typically refuse the deferral of the taxable gain.
Even if the partnerships are owned by the same individuals,
Correct.
it's still going to hit a different 1065 there. However, if you've got multiple properties in that partnership, you could move that replacement property to an LLC disregarded to the partnership.
Absolutely.
Because in that situation, if we got the P-ship and we move the property to an LLC disregarded to the partnership, well, we've still got the tax return. It's still hitting that same tax return. So from an asset protection standpoint, if you've got multiple properties in that partnership, then it would probably be a good idea to separate them out into underlying LLCs.
No question.
All right.
Oh, this guy.
Here we go. Put in a small plug for our tax and asset protection workshop. This is a one-day free webinar you can enjoy from the comfort of your own home, especially for those of you in those colder regions. Got some hot cocoa, a blankie.
And tax.
And tax. What could be better? Tax and asset protection. I'm actually will be joining you on December 21st. And we've got another one on December 28th, our last two of the year. Sign up. They're a fun time. All right. My wife receives passive income from multiple sources, real estate, consulting, etc. We plan to set up a C corporation to consolidate the passive income and offset some income with retirement contributions into a solo 401k. So kind of related to an earlier question. Fortunately, we did not set up the C Corp in time for the tax year 2024. What options do we have with respect to retirement accounts to offset her passive income for 2024? Okay, let's take this piece by piece.
Yep.
So passive income from multiple sources, real estate rentals, yes, passive income. Consulting though, is consulting generally going to be considered passive income?
Very rare.
Very rarely. If she's the one offering the consulting services, that's actually going to be active income. There's a possibility. What if you were invested into somebody else's consulting firm?
It could be, but it's highly unlikely.
That's pretty rare situation.
Yeah, I've never heard of it, but it's possible, I suppose.
Sure,
yeah.
sure. So, assuming all the income we're discussing is passive, what is the consequence of moving that to a C corporation?
Yeah, we wouldn't want to do that. The only way we could get that in there, number one, if we use the C Corp as a management corporation, we're shifting some of the rental income in there, but we wouldn't be moving it all.
Yeah, we don't want to put our real estate into a C corp.
Exactly. You never want to put if you put appreciable real estate into a corporation, real easy to get in, very darn near impossible to get out without a taxable event. And you're going to want to get it out eventually. There's no stepped up basis if you ever leave it to your heirs for that property. There's a multitude of reasons of why we wouldn't put
Corps
appreciable.
also pay higher, flat 21% tax, which is
Could be
1% higher than the highest capital gains rate.
That's correct. Yeah. And so, we got all these issues of why we wouldn't want to put in there. So the rental income, you don't want hitting that C Corp in that aspect that you're going to put the rental in there. But again, you could do a management fee and you could have your consulting coming in, and there you could pay it all out as W-2, which is earned income, and earned income allows us to contribute to the retirement plans. Now, it looks like we were thinking that line, along those lines when we were talking about setting up a solo 401k. But here we didn't do that. We don't have the C Corp, but you still have the consulting income, which is, I'd be willing to bet, kind of my bottom dollar that's going to be the type that's ordinary income, active income, subject to employment tax. That means we could put into a SEP IRA or a traditional IRA or both. So you got that earned income coming out of the rental. That's passive. That's not going to help us here.
What are the SEP and the IRA limits?
Yeah,
IRA is 7.
Yes, with 1,000 if you're over 50 for what we call the catch-up. And then our Yeah, the SEP is going to be 69,000.
69,000.
But it has no catch-up because it is the SEP is what we call a business expense. It's not the employee putting it in or whatnot, it's the business, so we don't have a catch-up for that.
And you can do both.
Yes, you can do both.
Right. Can multiple individual LLCs, a mix of small business and rentals, be consolidated into one tax return under a Wyoming holding company? And if so, is that recommended? Well, for rentals, that's going to be a pretty standard asset protection structure. We'd have an LLC owned by a Wyoming holding company. My mic is in the way here, I can't reach. And one property per LLC. That's pretty standard. So yes, if this is a disregarded structure, all just shows up on your Schedule E page 1. If you're married or if you own these through with a business partner, you could have a partnership tax return of 1065 here. Wow, that was bad. It's 1065 here. How does it work if you add in a small business? So let's just assume that this is like an active business. Are we wanting to put that under our Wyoming LLC?
Well, just to directly answer that question, can you do it? You could.
Yeah.
But do we want to? I think
People
I think
can do all
Amanda's
kinds of stuff.
Amanda's is the better question. Should you do that? Do we recommend it? Not at all. I mean, I wouldn't, because why do we have a box around that business to begin with? What typically that's usually where we're looking for our asset protection, is it not?
Yeah, I mean, we're typically looking to separate our active and our passive assets. So on this side, we've got our passive rentals going to our anonymous Wyoming holding company. When you're running a business, you typically can't be anonymous because you're either the face of the business or you're working directly in it. So you want to separate that. You don't want to create a direct line from you as an individual to your passive anonymous Wyoming holding company. That said, could you have your active business owned by a separate Wyoming LLC? Sure, especially if you're in a state where that active business, maybe it's an Inc., maybe it's an LLC. If it doesn't offer something like charging order protection, or it doesn't protect maybe a single member LLC in that state, then sure, have it owned by a Wyoming LLC. You'll get that extra charging order protection. Taxes will most likely end up being exactly the same. But we don't want to commingle those two things. This is more of an asset protection question than
It really
tax
is.
question.
Yeah. But they mentioned the tax return,
Yeah, they
so
do.
I threw it in here. But yeah, so could you? Yes. Do we recommend it? Not at all.
This structure, though, if both of these Wyoming entities are disregarded
No tax
and
return.
all these entities are disregarded, we're still only have one
1040.
tax return. We still only have your 1040. So you're adding in an additional holding company and still staying with one tax return.
Good point.
You could. All right, how much do we get to deduct with a 529 plan for our children? Elliot's response to this was, I've never looked into it because I don't have kids. I have 6 kids, and I've looked at it a lot. How much do we get to deduct?
We get to deduct nothing. There is no deduction for 529 at the federal level, okay? Some states might give you some deduction if you're doing an in-state plan for an in-state university. 50 states, 50 different answers to that. And no, I didn't research all those. But the federal, there's no deduction.
Well, some states don't charge income tax, so
That's
there's
true.
not 50 different answers.
Yeah, that's true. You're right. Well, that would be no
Because the
tax.
answer's no
But there's
on
still no
those things.
deduction.
Yeah. For example, we're in Las Vegas, Nevada. There's no state tax in Nevada. Thank you, everyone who makes your annual deposits at our casinos.
Right?
I have a 529 for my kids, so I wasn't pushed to invest into a Nevada state plan. I could essentially look at which plans across the country worked the best and choose one. I actually chose New York. I don't know, was probably doing well when I made that choice. So we don't get a tax deduction for that, but my parents they live in California and they get a deduction for the amounts they contribute to their grandkids' 529 plan. So it's gonna depend on the state. And it's going to have it's usually going to be limited to an in-state plan for the state that you live in. If you invest in an out-of-state plan, you're going to have to check those rules. We looked up an example, I think. Illinois If you invest in an in-state plan, you can deduct up to $20,000. So that's a pretty good
Pretty
deal.
respectable.
Yeah. And a 529 plan for those of you like Elliot, the childless cat ladies out there, what I like to call the real people with freedom. If you have if 529 plans are essentially a college savings plan, although they can be used for education lower than the college level, but essentially for qualified tuition expenses, things like that. You're putting in
After-tax dollars.
after-tax dollars, and then essentially grows like a Roth. So all of the earnings, all the growth is tax deferred, tax-free if you use it for qualified tuition expenses or education expenses. And then you can actually, this is pretty new in the last couple of years, convert the remaining amounts in a 529 to a Roth IRA. What are the limitations on that?
So we got an overall limitation of 35,000. So maybe not everything, but hey, we'll take it. 35,000 is great. And there's also a limitation. I think you cannot. It's kind of weird.
5-year rule.
Yes, there's a
Yeah, it's a
5-year
five-year
rule.
rule.
You can't put in more than what was put in
Can't.
subsequently to the last, or I'm sorry, before the last 5 years. So in other words, if you had it for 11 years, okay, the first 6 years you can put it up to that amount over to a Roth. That's one of the limits. But you know that 5-year look back rolls, you know, each year. So
And
that
that
might be.
actually makes sense.
It
Because
does,
college
yes.
is usually 4 years. So the idea is that you've had the plan, you've used most of it for college, that 4 or 5 years is up, and then whatever's remaining, as long as it's under $35,000, you can roll into an IRA for the kids.
Yep.
I guess they'd be adults at that point.
Yeah, but it's still great, very good. It's certainly better than doing nothing because it grows tax-free, as Amanda pointed out. So that's really nice.
All right, certainly better than doing nothing.
Yes.
Indicates that Elliot might not like 529 plans.
No.
Tell us why.
Well, I don't like it. I just don't
You
like it.
prefer the Roth
Yeah,
IRA.
probably not. Yeah, I do. Because you're already a Roth then. And if we didn't need it, let's say the kids got scholarships or something like that, well, you already have it in there. I don't like the overall, with the cost of tuition, $35,000 doesn't seem very generous to me. It's certainly better than nothing. I'll take it. Don't get me wrong. But I would have liked to have just started as a Roth, had it grow for the kids, and you can put in your contributions. You know, after 5 years, after that Roth is settled, so hopefully you start young with you'll start early with the young ones. Then you could take out for college expenses and things like that, and not be penalized. So
Yeah, the original amounts you had put into the IRA after 5 years, you could take it out,
Yep.
tax-free, and then pay for college that way. But if you're getting a late start,
Yes.
your kids are in their teens maybe, and you got to beef up that plan fast, a
529.
Roth IRA is you're still gonna be limited to that 7,000. So
That's true.
maybe that's the situation.
And there you can front load on the 529. That's another, I think, a really great plan. You can put up to 5 years in there. Of course, then you can't contribute for 5 years, but that allows someone to, in year one, to put a whole lot in there and get it growing tax-free. So they've come a long ways. You know, 10, 15 years ago when I started in this, the 529s were very kind of not good.
Back in my day.
Right, exactly. Back in Grandpa Elliot's earlier days. But now they've really done a lot to make them more attractive.
All right. Last question.
Of the year.
Of the year.
This is it, folks.
This is the last Tax
We don't
Tuesday
have
of the year,
we don't have a
everyone.
soundboard.
So our next one's not going to be until Tuesday, January 14th. So mark your calendars, or even better, subscribe to Toby Mathis, and
Yes.
you'll get a notification when we come back live in the new year.
And
All right.
we better get this one right.
If I gift my stock to my aging dad and become the beneficiary of the stock when he passes, will I get the step up in basis after I inherit them?
Yeah,
After I inherit the stock.
that's right. This is fantastic. Yes, you can do this. This is a great, for those who have, you know, the younger people who have done really well in stocks, you can gift it to your aging parents, and on their passing, they're going to take your basis, what you originally bought it at. Let's say you bought IBM at $10, probably not realistic, but if you did, and then you gave it to your aging parents, they would receive it at $10 basis, but they have the stock. Now, as long as they leave it to you when they pass, then you're going to get stepped up basis in that stock. And so all of your gain, that's a fantastic deal. But they have to live for 1 year after you've given it to them. So, you know, this is not something we do maybe if we're kind of on a watch or something like that.
Yeah, we got to keep dad kicking for at least a year in order to get that step up in basis. One thing I did think of after we were strategizing about this one is, what if dad is on some sort of
Yes.
Medicare or government assistance program?
Could ruin
What
that.
is that asset of this stock and the income from the stock going to do to that?
That is a fantastic one. You want to make sure you know what plans might be impacted by the asset wealth of your parent, if they're impacted, if you put a whole lot and gift it over. But all those questions aside, and you got to make sure dad leaves it to you, okay? Because, you know, I've seen, you know, fights.
Crazier things have
Right?
happened.
Yeah.
If you give it to him, it's his. And even if you have some sort of written agreement or contract,
Doesn't mean
that's
anything.
not really enforceable when it comes to inheriting.
That is a great point, because I can't gift to anybody and have strings attached. I can't say, hey, you know, here's your gift, and, you know, sign this paper saying you must leave it to me. That's not a gift. So, you know, yeah, you can't, there's no way you could really enforce the parent to do it,
Yeah.
other than be really mean to them. You know, I don't know if that would work.
God,
I don't think that would work.
We do
They
not
probably-
promote elder abuse
No,
on this channel.
Wasn't suggesting that, but yeah, you know, get them to feel guilty for not leaving it to you.
But you would get the step up in basis, but make sure that the additional asset and the income from those assets aren't going to affect any sort
Yes.
of government assistance or program your dad's in.
And that they're healthy.
Yeah, you end up paying a lot more out of pocket for the care that they're not able to get. Oh, you had also said something about Bitcoin, that this could work for Bitcoin.
We looked in that. We're not sure exactly. We don't know if crypto will have the same. Crypto has a lot of the same attributes as a stock. You know, it's capital unless you earn it, and then it's just like if you're in stock. But I haven't seen anything that specifically allows us for crypto, but it very well might be, and we'll continue to look at it. But we couldn't find anything yet on that.
Yeah, the crypto landscape's still a little wobbly.
It is.
A
And
little wobbly.
yeah.
All right, like we said, this is our last Tax Tuesday of 2024. Join us in 2025 on January 14th. Quick way to get a notification of that is to smash that subscribe button, as the kids say.
Yes.
Thank you for joining us. You can also subscribe to Clint's YouTube channel, Real Estate Asset Protection. Toby tends to focus more on on tax. Clint tends to focus more on real estate, but
They both know a lot about
they
both.
both
though.
know a lot about both. So you'll get all of that with both of them. And again, finally, a final plug to come join us at our tax and asset protection workshop. There's one this Saturday. It's totally free virtual event. And we got another one on December 28th.
And just, you know, again, thank you for a great year as this is the end. And thanks to our staff. We got Troy, Jared, Dutch. Who else we got? Kenny.
Rosh, Jeff, Patty,
Miss
Alyssa,
Patty.
Tanya, Jen. They do have the real magic.
Yes, they're the ones. How many questions? I don't know. How do we have today?
Ooh, I don't know. Hold on, I got the answer somewhere.
The Q&A.
Oh, over 100, almost 120 questions they answered.
Just about
today.
every episode, we're well north of 100. They do a lot of work, so thanks to the team.
Yeah, that's not even counting what you guys are sending us on YouTube
Right.
through the YouTube chat. But
Yes.
if you have a question you want to be featured in Tax Tuesday, email us, taxtuesday@anderson.com. Visit us at Anderson Advisors. If you're a Platinum client, submit a question, come to the Knowledge Room. If you say something really nice about Elliot, he promises to pick your question.
It helps. No.
All right, that's the end.
Thank you.
Thank
Happy
you,
New
everyone.
Year.
Happy New Year.